Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our 10th live stream series. We're truly grateful to have all of you join us, and we wish you, your family, and friends health and safety during this time. Before we dive into our topics today, I do want to cover a couple housekeeping items. First of all, we encourage you to ask questions, and we want you to be part of the dialogue with us. We have subject matter professionals that are going to be engaging today in the chat, so please feel free to reach out to them and ask questions as we're covering various topics today. Also, following the live stream, if you have additional follow-up questions, you can either submit them using the links below in the dialog box, or you can visit our COVID-19 resource page at claconnect.com. We have many developments going on as we have had over the last several weeks. There is a large bill going through DC right now that we're going to discuss today. And there's also many things that are going on in the lending space as well as the tax space. So we're going to be bringing in today a few different guests to cover all of these very important time-sensitive topics. We're actually going to start talking about the breaking developments that are going on in DC related to the fourth piece of legislation passing through Congress. This is the Paycheck Protection Program and the Healthcare Enhancement Act. So we've brought back Omar from the Franklin Partnership. As you may remember from Tuesday, Omar is a DC-based lobbyist and a strategist, and he has some updates. So welcome back, Omar.
Thank you, Leslie. And as we talked on Tuesday, things changed quite quickly here in Washington, D.C. Not normal for us, frankly. I've been here over 20 years, and they are moving at just rapid pace. In fact, we've got on C-SPAN watching right now. Looks like they're getting ready to start in a series of votes that will hopefully end up leading to the passage and extension of the 3P program. And the legislation you referenced that the Senate has already passed on Tuesday, the House that is taken up right now, we have $310 billion additionally for the 3P program for loans, with another $11 billion to help offset some of the administrative fees that the government's also absorbing through these process. Of that $310 billion, Democrats insisted and were successful in including provisions that set aside about $60 billion for two different categories of banks. $30 billion for each category, those that are between $10 and $50 billion in assets, and then also those for under $10 billion in assets. So those are what we call the set-asides that have been created there. One thing to pick up since we last spoke on Tuesday is we did hear on Tuesday evening that Treasury and SBA were already starting on a coding system so that these set-asides for the banks, it wouldn't cause any delays throughout the process. So they're hopeful that once we're up and running, those banks that fit within those asset limits will be able to have a special code and they will be set aside. And that's how SBA will hopefully reduce some of the time lag that we're going to have when they turn the lights back on here. But in here in DC, the concern is very, very real that these funds are not going to last very long. We just look at what we're hearing right now, what they burn through in just about 13 days. We believe that there's already 800,000 loans, as we reported, currently in the queue. So once they clear out these 800,000, if you do the math based on what the average is, there isn't a whole lot that's going to be left in new opportunities. So folks need to act very, very quickly and make sure they're already talking with their lenders, even ahead of this going. Right now, most estimates is maybe we get 10 days worth of funding, 14 if we're lucky, but one banking group said 48 hours is probably the best shot. Outside of the 3P program, again, the economic injury disaster loans, the EIDLs, they did provide an additional $10 billion in grants. You want to keep in mind there are two different components to it, a loan and then the grants that are forgiven. So that $10 billion would allow companies to have the first 10,000 of their loan forgiven immediately in the form of a grant under the EIDL. So they did provide a total of $60 billion, with $10 billion of that amount to be set aside for the forgiveness in the form of a grant. But then lastly, one thing that we took away from this, you asked the government, what are they expecting next? There was a provision to provide $2.1 billion worth of funding for salaries and expenses for the SBA to continue this process through September of 2021. So that tells you that they expect that there's a lot more work to be done, both for small businesses and for government.
Great. So that is a wonderful overview of just where we're at with the lending, which I know is a huge piece of this bill. But certainly this bill covers a few other areas. So what are a couple of the other really important components of this legislation that people should be aware of?
Absolutely. Obviously, we get a lot of attention in the media to the 3P program and the lending, both the success stories and some of those that aren't as flattering. But there was a lot of funding that was placed into this legislation that totals $484 billion. We have $75 billion to reimburse hospitals and healthcare providers for healthcare-related expenses or lost revenues attributable to COVID-19. So we know that lost revenue, especially with elective procedures being limited for a lot of health providers, has been something of great concern to those folks in that industry. So we suggest to make sure you contact CLA and see what some of the funding and what this can mean for systems that are out there. In addition, they do have $25 billion to increase testing for COVID-19, with a certain amount, about $11 billion for states, localities, and the tribes as well across the nation. We also saw that within that $11 billion, they are looking at for a number of items where they break it down for this between the states. And then also CDC is going to get additional funding for surveillance, contact tracing, and other activities to support that testing. Then lastly, there's about $3 billion, $2.8 billion for point of care and rapid diagnostic technologies, with some set-asides for community health centers, about $600 million to support testing, and for the rural communities as well, about $225 billion, $25 million rather, that'll be set aside. Lastly, what they also have in here, a couple other things with regards to testing. There was a back and forth over the last week of who was going to be responsible, whether it's the federal government or does that fall onto the states. There is a power sharing, so to speak, agreement in here. So you are going to see a lot more testing that's pushed out, not just because of the dollars amount in here and the funding, but that they are saying that the federal government needs to come up with some kind of a plan with regards to how they're going to do this. And it is also interesting how we take a look at the additional funding levels that we've got in this bill. And I think it's hopefully going to carry for a little bit, but the way we're burning through cash, you might see another round in the coming weeks.
Absolutely. So that was fantastic. Very important updates in there. Let's talk just for a moment about where it stands at Congress and then what we should expect from a timing perspective, because as you mentioned, some of this is moving fast and it will matter.
Absolutely. We're moving very quickly. As you see, one eye's on C-SPAN. We're going to have two series of votes today, both related to COVID-19. The first vote is going to be on a House resolution Democrats are offering to set up a select subcommittee to look at the coronavirus. And debate on that began about an hour and a half ago or so. They were scheduled to start vote actually at 1:30 today. That has been slipped to starting at 3, which they have not begun. So we expect those votes to start on this initial measure probably here within the next half hour. It's really interesting how they're doing this. They are having members of Congress voting in groups. They have set aside 8 groups alphabetically. You're all essentially required to stay in your personal office until you get a call from the majority whip saying it's your turn to go down to the House floor. And so that's going to also take some time. The reason we mention this is because they're going to work on this vote first, and that should eat up about another hour and a half till we get to the 4 o'clock Eastern hour. Then they're going to take a 30-minute break to have the House floor cleaned and sanitized. Right now, what they're doing, you can see they're going with wipes and wiping down the microphone between each speaker when a representative comes down to the floor. And so that's going to take up some time. Hopefully, we'll start to get to see the 3P vote sometime this afternoon. Might start at 5 o'clock and could push into, I think that the president's going to want to say something during his prime time that's up there. So effectively, we probably will have an idea. This should be wrapped up maybe around dinner time Eastern this evening for the entire $484 billion bill. So the next question is, what happens to the lending programs? When can the 3P lights come back on? SBA is going to have to open up their e-transaction portal for the lenders, and we expect them to probably issue some notice of when that will happen. So do not expect with the stroke of the president's pen this evening or early tomorrow that immediately we're back in the game. There is going to probably be a notice that will say the date and the time that they come out. But regardless, members of Congress that my partner and I are already lobbying have already begun talking about the next phase. And so that's going to be a much larger bill. And you have to keep in mind, it's going to take time because now with Congress coming back on May 4th, you're going to have regular order. You're going to have speeches on the floor. You're going to have votes. You're going to have debate. And so don't expect the next phase of the COVID-19 bill to come through nearly as quickly as what we've seen here in the last couple of weeks.
Well, that's great. We really appreciate your timely updates, and I'm sure in the next 20 minutes you'll keep us posted if anything else develops. So thank you. Now we'd like to switch over to Todd Sprang. Todd, you've joined us for many sessions, and we are thrilled to have you back. Obviously, Omar talked quite a bit about the lending perspective. and what that's going to look like with the new bill that's coming out. But you've got so much intel to what is happening inside the financial institutions. So what we'd like to do, Todd, is just start really with what the banks are seeing from the PPP perspective and what intelligence you might have related to that.
Sure. Thanks, Leslie. I'll pick right up where Omar left off when we talk about this additional round of PPP financing. But let me say, I think a couple points that I'll make are relevant, whether you're waiting to get into this round or you've already obtained some funding, okay? Mm-hmm. But when I think about the proposed funding that Omar was talking about, and when the SBA flips on that switch, the lenders have already been, as many know, taking applications and processing applications on their side to be ready for this moment. So they've gotten the information from the borrowers' apps. They've been processing. They've received internal approval in most cases, if not all cases, and they're just waiting to submit to the SBA to get that approval so they can turn around and fund. So that's a positive development, is that with they've been preparing for this additional funding, and we think that'll go well. And as Omar said, there are provisions that from the SBA side create some nuances with respect to how the funds are allocated to lenders, but that's kind of out of your control as both as a lender and as a borrower. You just have to submit your application through the process and get it funded. So I don't anticipate, like he said, any delays or any issues caused by that, the allocation of those funds. I think second is there's a lot of talk about forgiveness and a lot of frustration on both sides about the lack of forgiveness guidance that's come out from Treasury. So everyone's waiting for that. From the borrower side, we know that the borrowers are looking to that guidance because they want more clarity that will help them plan for forgiveness. The clock's already ticking on that 8-week period, that measurement period that they're subject to. So every day that passes by that they don't have guidance makes it harder to plan. They're working off of assumptions. They'd rather work off of facts and know the rules of the game, so to speak, as they go. The same is true on the lender side. There's a frustration there too, because without that guidance, they're getting questions from borrowers that they can't answer. And also on the lender side, they're just not able to plan for the liquidity. Think about the fact that when this forgiveness is granted, right, then that provides the lender with some additional liquidity because they can then get the proceeds that they've dispersed. They can get them back from the SBA. So they're also interested in moving that forgiveness, I'll say, phase along and getting that liquidity, and they'd like to plan for it. And right now, they're just not able to plan for that. Lastly, let me talk about a few uncertainties that exist right now and that get a lot of discussion amongst both borrowers and lenders. First on the side is borrower accounting. How do you account for those funds? There were some issues about, is this a grant or is this debt? That makes a big difference, because if it was determined to be a grant and you had a larger amount of PPP proceeds that you received, you could be subject to single audit in that instance. And so that would occur some additional time and expense on that side. And so that's one area of uncertainty. I think another area of uncertainty on the borrower side is there was some assumption that all the lender notes were uniform since the SBA came out with language, but there's variance among those. So I recommend that every borrower go back, read and understand the requirements of that note, because we understand that the circumstances were such that you didn't have much time to maybe review that or understand all the nuances. Go back through it, take a look for the information requirements and maybe other things that maybe you didn't have an eye on the first time. And then lastly, let me talk about something that I'll call program compliance requirements, okay, and compliance risk, because that's an area where I think we're receiving a lot of questions. A lot of our CLA practitioners are receiving that. So this is an area that lenders understood and had some apprehension about based on past experience with SBAs. The question is, there are a lot of clauses in these agreements or a lot of requirements. And so what happens if you aren't absolutely fully compliant, or you're found later, some questions that you have, right? And how much second guessing will the SBA come back and attribute to the situation after the fact? And so that risk has been out there. The lenders have understood that, but I think the borrowers are beginning to understand that better, because the questions are like, well, now I've got the proceeds. what happens if I can't spend all those proceeds?
Yeah.
And I want to spend those proceeds on something that's not, I'll say, an expense that's covered under the program, right? Can I use it for other working capital purposes? Or, hey, maybe when I made my application, I made certain assumptions because the situation was evolving really quickly. So maybe I wasn't able to clearly estimate what my financial need was. So I represented financial need at a time, and maybe now the situation isn't as dire as I thought now that some more time has passed. So those questions are, what do I do? And let me just summarize what I'll call that compliance risk for you, is if I think back about what that audit process ends up, and I'll call it an audit process on the SBA look back, is we can expect, or we expect on the lending side, some sort of process where the SBA comes in after the fact and looks at the program and how it was complied with. And so there is an expectation that they'll grab some of these files and look for borrower and lender documentation, okay? And when you do that, I'll say, I looked at the program, the way the dollars were dispersed, and as an auditor, I was sitting there thinking, well, if I wanted to get the most dollar coverage for the least amount of work, what would I do? So just to give those borrowers an understanding is if I'm the SBA and I'm coming in to try to get an understanding of program compliance and I want to cover dollars, with the initial reporting that they did on the first round, you could cover about 45% of the loan proceeds by looking at about 4% of the borrowers. So a typical approach would be something like that. Yep, pull the bigger ones and then go smaller from there. But there is positive news, because that sounds like a compliance requirement that, some may not find, very attractive right now. And the good news is Treasury came out this morning with some guidance that said, in short, you have the ability to repay your loan back in full by May 7th if you find that maybe you have current data or you can reassess. What I'll call it is it's kind of an avenue for you to reassess and say, you know what, I'm just going to return the funds because for various reasons I might return the funds. So it kind of opens that door, creates a path to which you can do that. And they'll say that if you do that, if you return those full loan proceeds, not partial, but full loan proceeds by May 7th, then you will be deemed to have been in compliance and in good standing with your certifications, and they won't hold that against you.
That's great, because it's all going fast. People are moving very quickly, and we don't have all the guidance yet. But I think, what I take away from hearing you talk is just be transparent with people, do the best you can, make full disclosure, and then start keeping really good documentation. And if you do that, then the documentation and the paperwork are going to catch up with us here.
Correct.
So that's great. That's a really good overview of where we're at with the PPP. Let's pivot now to the Main Street lending. We discussed it briefly a week ago, but we really have just scratched the surface on it because there's been so much buzz around PPP and EIDL. So can you revisit what are the main points for Main Street lending?
Sure. I'll summarize the main points that right now are in the term sheets. And as of last night, there was no additional information on those term sheets, but they were subject to a comment period. So what I'm going to do today is I'll give you the term sheets as they stood, and then I'll give you some summary based on a review of some of the comments that have been made on that program, the public comments that have been made, because there's been over 2,000 comments on that Main Street lending program. Okay, so the basic overview of the terms is this is a longer term instrument. It's got a 4-year maturity. It's got 1 year deferral of payments, which provides a longer term solution versus PPP that's a shorter term solution. Again, this is a loan that under these Main Street programs, there's 2 programs, but they basically operate very similarly, if not almost the same, in that the institution makes a loan to the borrower. There's no forgiveness concept to it, though. It's more a straight loan. And then instead of retaining the loan on their books of the lender, the lender would sell it into an SPV. So they'd get it off the 95% of it off their books that way. But this operates a lot more like a loan. And when you look at the terms and the rate on that loan, it's got the SOFR is the base rate on that. That SOFR rate is basically 0 today. Mm-hmm. So when you add the variable component of 250 to 400 basis points, or 2.5 to 4%, you're looking at a 2.5 to 4% loan with a 4-year term. And that's pretty good financing, like bridge financing in this type of environment. So I think borrowers would find that very attractive.
Sure.
For that rate, though, in exchange, you're going to make certifications. So there's going to be some things like, you can't pay down an existing debt. You've got to maintain, do your efforts to maintain employees and payroll. And there's restrictions on compensation and capital and distributions. So there are some what I'll call hooks associated with that, right? Mm-hmm. But another benefit is you can get $1 million up to $25 million with the new loan facility. And that's subject to some restriction based on a calculation that's got EBITDA on existing debt and undrawn debt, outstanding and undrawn debt associated with it. And then if you participate in the existing program, then you've got higher limits. You can go up to $150 million, but you're still subject to additional limitations based on debt levels or based on a combination of debt and EBITDA. But let me quickly summarize. Since those are the terms as they stood, let me quickly summarize just a few of the comments because they may give an indicator of some changes you might see or that are being lobbied for. So under these programs, the comments did express a desire to have a lower loan amount. $1 million was a pretty high threshold, especially when you consider those limitations in EBITDA, because if you don't have, if those EBITDA calculations are straight EBITDA right now, and so if it's not adjusted EBITDA, you might have a lower loan amount for certain people, mm-hmm. and it may, I'll say, prevent certain types of entities with lower negative EBITDA from participating in the program. Second, there's some limits on distributions, and that could hit, like, say, an S-corp distribution. It could impact where they have to make S-corp distributions for tax. Or maybe distributions from a company to a holding company to pay expenses because the holding company doesn't generate revenue. Those are some of the common things. I think the last thing I'll touch on is the definition of debt. It's pretty vague on the definition of debt in that program, and that needs to be clarified because it's so important in these calculations.
That's great. Well, I really appreciate you talking about the two pieces of lending today that are out there. I know that we also have some guidance on CLA Connect related to some alternative lending sources, and people can definitely check that out. At this point, I'd like to bring in Chastity to also talk about layering in the tax elements of that. So we really appreciate your time today, Todd.
Thanks, Leslie.
Chastity, it is great to have you back today. For those of you who haven't seen Chastity on Tuesday, Chastity leads our National Tax Office at CLA, so it's great to have you back.
Thanks, Leslie. I appreciate you inviting me back.
Chastity, tax is such a key component of organizations' liquidity. I often tell people that it is the silent partner in every decision that we make. And with that, I think there are a couple areas that are very time sensitive that people can take advantage of right now. Tuesday, you talked about the retention credits and the workforce credits. One thing that's super timely, though, I think, and ties into what Omar and Todd talked about was payroll tax deferral and some interplays that we've got with the lending. So can you talk about the deferral and then talk about repayment?
Yeah, Leslie. So there's really four critical pieces that you need to know about the deferral. And this is a deferral of employer Social Security tax. So there's been I get a lot of questions about this from our clients, and there's been some confusion. Clients will say it's a FICA deferral. It is not a FICA. FICA includes both Social Security and Medicare. It's just the employer Social Security, the 6.2%. But the most common question I get is what employers qualify for this deferral? And that's the great thing about this deferral. There's only one limitation. So this applies to all employers, regardless of size. And another common question I get is, are governmental entities eligible for this? And are tax exempt organizations, can they make themselves available to them? And yes, it applies to all of them. So it doesn't matter if you have 501 employees, you get the deferral. But like I mentioned, the second thing everybody needs to understand is the one limitation. And the one limitation is if you do get, I call it PPP, loan forgiveness, then you're not eligible for the deferral. And before the IRS came out with guidance, there was some confusion. Well, I don't know. I might get a loan, but it might not get deferred. So can I defer? luckily the IRS came out with FAQs and clarified that point and said, yes, you can defer. Even if you get a PPP loan, you can defer up until you get that decision from the lender of forgiveness. And so any tax that is deferred in that period will be you can continue to defer that to the date it's due. So let's talk about that, because you asked me, when is this deferral due? There's 2 due dates. So the first 50% of the deferral is due on or before December 31st, 2021, with the remaining 50% due 2020 on or before December 31st, 2022. And just to clarify, that deferral period starts May 27th of this year and runs through the end of the year. And so those are the key components. It's a fairly simplistic, if you look at the statutory language, there's not a lot, because it's really intended to have broad applicability.
Well, thanks for clarifying that, because that does go so hand in hand and is so timely with what we're seeing with the PPP lending. I want to pivot now, because I think another really big opportunity for taxpayers with liquidity is related to net operating losses. So those changed quite a bit under the CARES Act, and I'd love if you could highlight what those changes are, what they've been, and what that means from people, especially in terms of some of the time-sensitive actions they need to take.
Yeah, Leslie, and this, unlike the deferral, relates specifically to income tax. So I know there's been some questions like, what do I get from a credit from the income tax perspective? So we're going to talk about NOLs, and that impacts your income tax. And you're right, it changed substantially with the CARES Act. So back with tax reform, starting in 2018, NOLs were changed dramatically for corporations and individuals. And that change was you could no longer carry back your NOLs. Plus, your NOLs were subject to an 80% limitation. That's 80% of taxable income. So significant change. What the CARES Act does is changes that and says you can carry back losses incurred in 2018, 19, and 2020, and you get to carry back of 5 years. So this is incredible. It's a huge benefit, because what we have to remember is with tax reform, tax rates were reduced. So now you may have the ability to carry back to years where there was a higher tax rate. So that becomes permanent tax savings. And so what's the urgency around that? The urgency is particular to 2018. So what the IRS has always had since I've been practicing is the ability to apply for what's called a quick refund. And the concept is to get your refund quicker than if you had to file amended returns. And generally there's a time limit when you can file that form. There's 2 forms, the 1139 for corporations and the 1045 for individuals. And unfortunately, that time had already expired for 2018. So with the IRS came out with some leniency and issued a REPROC and said, look, we're going to extend that. So you can actually file an 1139 or a 1045, which is a quick refund, if you file that by June 30th. And again, this is for the 2018 tax year we're talking about. And so that is urgent, because it's a way to get cash quickly. And the interesting thing is, most people are probably aware, if you do anything with the IRS, that their service centers are pretty much shut down. They only have a very bare bones staff available. And what they did was they're allowing people to fax these 1139s and 1045s so that they could be processed. So that's huge.
Yeah, it's a really big deal. And so I think we've got tax returns in various stages. You've got 2018, which has been filed, although there may be some strategies to go back and take a look at those. A lot of people may have 2019 pending, and then we've got 2020 on the horizon. So when we talk about really effective tax planning and using that to your benefit, I think there can be some strategies to create NOLs, to enhance our NOLs. What do you think some good strategies are that our listeners should be thinking about?
Yeah, that's a great question, Leslie. And if we had 15 more minutes, I could run through 15 strategies. So what I'm going to do here is I'm going to focus on 3. And it's the common 3 that I see. So the first one is really, so we're talking about how do I increase my loss in 2020, because you're going to have the ability now to carry back up to 5 years. And so the first planning strategy is really to consider purchasing equipment. Mm-hmm. There is with tax reform, there's a huge incentive to purchase equipment because you get 100% deduction on most equipment you place in service. So if you think about that, if I go buy equipment in 2020 and I get an immediate deduction for that, that's going to increase my cost. And it's a fairly simplistic strategy. Mm-hmm. So that's strategy number one. Strategy number two is look at your depreciation. And so one of the things that the CARES Act did was correct what we call a retail glitch. So when tax reform was passed, effective back in 2018, there was an error in the legislation, and they left out certain property that was eligible for bonus depreciation, that 100% deduction. And that was commercial improvements to commercial property. We call that QIP. They have corrected that and had said that now it can be bonus depreciation. So they've issued guidance that you can take that in 2020. So that's one strategy. But another really great strategy is real estate has a lot of nuances to it. Mm-hmm. And it can have several different class lives. You think, well, real estate probably only has one class life. Not necessarily. Now is the perfect time to do a cost segregation study that can look at what is your real estate? What is there? Maybe some classes that we can move property into an accelerated depreciation, less years. And that's going to increase your depreciation, which is going to increase your loss. Another one, my final top three, the third one, a lot of people don't think about, but I think, particularly in 2020, is if you're an accrual taxpayer, you have the ability to write off uncollectible accounts. Mm-hmm. Now, there's some very specific requirements around that, but I would urge, accrual taxpayers to look at that and really evaluate, are there uncollectibles that I can write off? Because that's a deduction. And with any deduction, as your deduction increases, if you have a loss, your loss is going to increase.
Well, I really appreciate those strategies. I think that, people, if they have more, reach out to your tax advisor. But we really thank you for joining us today, Chastity.
Thank you.
So many of you have asked questions, and I think we've got a lot of dialogue along the way today. And we would just say, if you've got more questions, please follow up with your CLA professional or use the dialogue box below. We will continue to address your questions over the next few weeks as we get more guidance and legislation. I want to thank all of our specialists today for their time. I want to thank the moderators that we've had on the chat, and thank you, the audience, as well. Thank you.